Good morning. Today is January 21st. It's a Thursday, and I thought it would be really helpful to provide some insight as to what's been going on in the stock market lately. We've seen some significant volatility over the past 2 months specifically. The S&P and Dow, S&P 500 and the Dow Jones have been down roughly 11.5%. The Russell 2000 down about 15%. That's a index that measures the performance of smaller companies, whereas the S&P 500 measures larger companies as well as the Dow. We've seen international stocks be down similar percentages, if not a little bit higher than the U.S. stocks. In bonds, they've been relatively flat, if not slightly negative or slightly positive, depending on the actual bond that you own. So why have we seen all of this volatility in such a short period of time, this 2-month period? It's really difficult to know exactly why we've seen a lot of the volatility. One of the things that we think it is China. It's the ongoing story that we've heard, but China is getting some blame for some of this downturn in the stock market globally. And China is obviously a big driver, but whether or not it's justified is a different story. When we look at it, only a small fraction of U.S. spending, known as the GDP, is representative of China. So there's not a whole lot of activity that we have with China. It's a very small portion at the end of the day. Additionally, only 3% of the world's investments are in China, whereas you compare that to the U.S., it's closer to 50+%. So in the grand scheme of things, China is a very small player. Even though they have billions of people, they're a very small player at the end of the day. Another reason that the markets could be reacting so volatile lately is due to the low oil prices. We've seen here in St. Louis, Missouri, where gas prices are around $1.45 per gallon as of this morning. And if we go back even a few years ago, we saw that gas prices were $4 per gallon, and people were complaining that the price of oil, the price per barrel of oil was significantly high. The price at the pump was significantly high, and we were complaining about that, and that was the reason and justification at that time for why the market was doing poorly. And now here we are several years later, and the oil prices have come down. I think the last I checked, the price per barrel of oil was around $27 per share, whereas several years ago, I think it was hovering close to $100 per barrel. And now we're seeing really low prices at the pump as a result of that today. And for some reason, we think that has spooked people and has caused the markets to drop rather precipitously. It could also be that some people are just nervous that the stock market has done so well the past few years, and for fear of a recession, they thought it was necessary to sell and capture some of the gains that they have already achieved. The reality is, at the end of the day, we don't really truly know what's the ultimate driver behind these things. Yes, I believe it's China. Yes, I believe that it's oil. And yes, I believe that a part of it is just people being nervous. And the reality is the stock market reacts to these things emotionally sometimes, even if they are not a good justifiable reason for why the stock market has dropped. The stock market will react to that news over time. At the end of the day, I'm not really that concerned. And you shouldn't be either. And I want to give you some reasons why I say that. Let's talk about what's gone really well lately. The media does a great job of talking about the negative aspects of the stock market and the volatility, but they neglect to talk about the things that have gone really well. So over the last year, we've seen the stock market do relatively poorly, especially these past 2 months, but the U.S. dollar has strengthened in value. If you go back a few years ago, all the talk, especially in the media, was about how the dollar was being devalued. And now here we have a strengthening dollar, so that's a good thing. Home building has reached its highest level since 2007. As I mentioned earlier, oil prices have lowered significantly. That's a good thing for your wallet. We've seen really low inflation, really since 2008. And the U.S. job growth is the strongest that we've seen since 1999. So all of these are really positive things that are pointing in the right direction. And unfortunately, the stock market has reacted negatively to some of this recent news. Historically, I want to share with you some of the stats that are prevalent in our nation historically. Over the last 89 years, so going all the way back to 1926, the U.S. stock market, as measured by the S&P 500, it's the 500 largest stocks in America. Over the last 89 years, there have been 24 years that have had a negative return. So said a different way, that means that the stock market has been down 27% of the time. Now, those are odds that are significantly in your favor. So keep that in mind if you're an investor in the stock market, that those are odds that are really to your favor. The market's down 27% of the time on average. That means that it's up 73% of the time. Research has consistently shown the stock market, at least over the last 20 years, ending in 2013, and there's been a lot of studies done through multiple 20-year periods, but from 1994 to 2013, the U.S. stock market averaged 9%, but the average investor only earned 5%. So why is that? Why would the average investor earn much less than the actual market provided? And the reason is that people panic and they move money into and out of the stock market at inopportune times. Today is a very good example of that. At least these past couple of months are a very good example of that. People are fearful. We're getting calls from clients, saying, what should we do? Some people are saying we should have sold a long time ago. But what ends up happening is you end up being one of these statistics where you're the average investor if you're moving money in and out of the stock market at an inopportune time, and you end up having a much lower return. And so just to recap, a 9% return for the market, but the average investor was somewhere around 5%. That's a significant decline for making an emotional decision with your investments. Gains and losses almost always come in a handful of days. It's very rare that you see a steady Eddie approach. The market slowly gaining or losing a little bit, fractions of a percentage every day. It usually comes in big handfuls. And we've seen that over these past couple months. As I mentioned, the U.S. international markets are down significantly, in some cases approaching 20% decline just in 2 months. So it's very difficult to predict when those gains or losses are going to be coming. One stat that we found that we ran into several years ago was a study by B.E.S.T and Associates from 1994 to 2008. That's a 15-year period which had 3,827 trading days, stock market trading days in that time span. The S&P 500 returned 6.5% per year during that 15-year period. The interesting thing is that if you missed the 10 best trading days out of those 3,827 days, the return would have dropped from 6.5% all the way down to 0%. The moral of the story is it's very difficult to know when those gains or losses are going to come, and it's a much better strategy to stay invested through the long term, ride out the 27% of the time the market is down so that you position yourself to take advantage of the 73% of the time when the market is actually up. So what is the takeaway? Number one, you can't predict when gains or losses are going to come. Number two, as I just said, you have to ride through the period of time when the markets are down, which is a relatively short period of time, 27% on average. The people who panic and sell are the ones who are going to be on the short end of the stick. They're going to be the ones with the lower return at the end of the day. This is an interesting point. The stock market is not like the casino. A lot of people have this mentality that you're just gambling with the stock market. Well, when you go to the casino, your fortunes are tied to some arbitrary roll of the dice or the arbitrary flip of a card. The casino is there to make money for themselves. The stock market, if done appropriately and not with an emotional bias or emotional decision making involved, you can make money. And the reason I say the stock market is not like the casino is because you're actually an owner in the stocks that you purchase. A lot of people lose sight of that fact. You're an owner of Google, of Facebook, of GE, of Apple, Microsoft. You're an owner of thousands of different companies. And these companies, they have the ability to produce goods, to provide services, to have sales, profits, hire, fire people, produce dividends. So you're actually involved in an owner in a productive company, where the casino is just you hoping to receive a fortune through a flip of a card or a roll of a dice. That's a significant difference. So please don't look at the stock market as a gambling effort like the casino. Another takeaway is continue to make your contributions. If you're in the phase where you're growing your bucket of money for your retirement, continue to make your contributions. Yes, your share value may be down. Your market value of your account may be down, but your share quantity is likely up. You're continuing to make contributions. There's dividends and capital gains that get reinvested and buy additional shares. So even though your market value is down, it's a very high likelihood that your share quantity is actually up. And if you're one of those who are actually in retirement and receiving money from your investments, it's true your share quantity may not be up. It may actually be going down slightly, just due to the fact that you're having to liquidate a portion of your account to provide yourself with an income. But the same story holds true. At the end of the day, history shows that if you just kind of let things stay where they're at, have the plan in place, the investment strategy, be comfortable with it, and ride out this storm that we're going through, you'll find out that you'll be on the better end when the market does rebound. So I hope that this insight has been helpful to you. If you have any questions or comments, I encourage you to leave them in the comment section below or reach out to us, and I'd be happy to talk with you through any issues or concerns that you may have. Hope you have a great upcoming weekend.